you know, it felt like the old days. I got the train, first early train into London, worked to my desk, left the office, got the train to St Albans, had my meeting, got a taxi back to the station, came back to the office, and I'm back. Whereas in the new days, you're get in a car and drive, don't you? Go home, work from home.
Which I do, but then I live in the sticks. So
yeah, which I would have done if I didn't have this.
Got you.
I'm glad you've made.
That's just showing
the effort
off.
to come in.
That's just showing off.
That is showing
only
off.
because she's just emailed me, so I wanted to know how she'd done, just because they put money in around.
Showing performance that's up with
No,
benchmark.
she's just
Haven't any of
Jonathan
those
Performance Raymond.
he is charged.
Right, fellas, let's go. Ready to go?
Ready to go.
You've got an agenda.
I've got an agenda. We've been rolling for the last 2 minutes as well.
Oh, have
so
we?
it's been good. Yeah, absolutely. Absolutely. I'm very excited about this. I wanted to get some of the pearls of wisdom before we kicked off from you two, because you two actually know what you're talking about.
He does.
He does. Right. I'm
James
David
wearing a
Henry,
tie.
investment manager.
We're a tie for a reason.
You're wearing a tie for a reason. Absolutely. Right.
Looking professional.
This is all very professional. This is the first of hopefully many conversations to come.
Yeah.
Taking stock after the bell. These are your three regulars, for better or worse. I'm David Henry, investment manager in the London office. I'm joined by James Hughes and Jonathan Raymond, CFA. He's got a laptop in front of him, so you can tell he knows what he's doing. Right, fellas, where do we want to start? I think there's only one place we can start. Footsie 8,000, baby. Here we go.
It's brilliant, isn't it? I mean, I didn't get my hat out for today, but I should have done. I mean, for the last 3 years, until last year, we've been told to sell all our UK equities. BP and Shell were dead. Microsoft and Amazon were the way to go, and the FTSE's been left behind. And lo and behold, the FTSE had a pretty stonking year last year, both up absolutely, and well ahead of global indices. We've got the MSCI UK Large Cap Index, which is an even more concentrated version of the FTSE, isn't it? I think there's only about 80 stocks in here. So, you know, BP, Shell, Astra, Diageo, Unilever. Given what we've been through in the last 12 months, those sorts of stocks are the ones that you absolutely wanted to own.
How many emails did you get from clients a couple of years ago saying, why do we hold any UK at all? Not to pick on people, because, you know, it's human nature to look at stuff that actually isn't working and say, why are we holding that? But lo and behold, good things happen to cheap assets quite a lot of the time, right?
Yeah, and even today, if you look at the index at 8,000, the PE on that index is just over 10 times. It's not expensive. It's not like the S&P was last year. Not last year, the year before. But yeah, so going back to your question, you know, I think lots of clients questioned why we had any UK equities within our portfolios, because that was where the major detraction came from. If you go back to do that, you know, the index hasn't really done anything since 2000. If you take dividends out of it, we all know that, you know, the FTSE does yield much better than other developed markets. You know, pick out a couple of the minors. You've got Anglo's yielding almost 8%, Rio's 7%. Last year they were incredible performers as well. It's but having spent years writing about why the FTSE had detracted and how it was painfully destroying my performance, I then had lots of questions asking why the portfolio hadn't kept pace with the FTSE index. And that was a challenge for clients, because I think that's their go-to index. All the times other developed markets are outperforming, portfolios are doing better than the FTSE 100. You know, everyone feels very happy, but when that reversed last year, that's definitely where there was more of a challenge from clients.
Definitely.
And some explanation around why.
I mean, it's been not a great run. I mean, I wrote about this earlier this week about the performance of the UK market versus the rest of the world. Last year was the first year since 2011 that actually the FTSE has outperformed the rest of the world. I mean, look at that run going back to 2011. That's basically the entirety of my career. Yeah. It's been a one-way trade. Thoughts on why that's been? I've got a couple, but let me hear what you think.
I think we'd probably start with interest rates.
Interest rates, low rates generally favours growth stocks. technology fits into growth. So the Microsofts and the Apples of the world. We've had 10 years of falling rates. The Footsie has got virtually nothing in technology sector-wise. And on the flip side of that, it's been a pretty bad decade for commodities. Commodities boomed in the late noughties and again peaked in 2011, and since then it's been a one-way street until last year, where 2015, 2016 the oil price fell catastrophically, and then we had COVID on top of that. So the UK market sectorally was in the wrong place in a decade of essentially technology beating commodities.
Yeah. You had the China super cycle as well, didn't you? Which
I
played
was
into
just
it
about to say,
on
'cause
hard materials.
that was the narrative when you and I started working together, JR, about the Chinese super cycle. What was the stat about building a city the size of
20 cities the size of Chicago were going to be built? It was
fast forward 10 years and you can't give these stocks
No.
away. It's amazing how it happens, isn't it?
Yep. And that's why, again, that's why the FTSE screens on a P basis so cheaply. These miners and oil stocks are cheap on an earnings basis.
Counterpoint, I put it to you that they're over earning because commodity prices have exploded higher over the last couple of years.
Yeah.
You're going to see a little bit of earnings downgrades this year from the oil companies at $75 an oil. It's not at 120 like it was in March last year. So earnings will be a bit lower for some of those names. But China reopening this year. Energy transition is a long-term structural bull case. If you want to build offshore wind turbines or you want to build solar panels everywhere, you need lots of iron ore and lots of copper, and that's the very sad nature of kind of the energy transition. Is that lots of these commodities are going to be in high demand for the next 5-10 years still.
I mean, we've seen Tesla looking to potentially buy deposits in West Africa, places like that, because there's such a shortage of rare earths, and whether it's lithium or nickel or copper, they have a problem of what's going into the cars and into the batteries, especially as they're building out the battery technology as well. It's not just in the cars; it's batteries in terms of linked to solar panels on roofs and storage facilities and things. So it's that energy transition. I think it's key, and when we speak to experts in those fields or oil and gas and materials analysts, I think the thing that will be supportive of oil companies in particular is the under exploration and investment that's gone into oil and gas over the last 10 years. Because when I first started running money in 2004, our portfolios looked very different to what they did 3 or 4 years ago, even 10 years ago. We had lots of financials. We had lots of oil and gas, lots of miners. We all had Tesco supermarkets, Morrison's at the time, and just that construction was so different to where we are today. But there were lots of junior mining companies and lots of junior oil and gas companies being listed by brokers across the city, and that's where lots of exciting capital was going. So, I think if I go back to 2004-05, and we discussed it a lot, we had one tech fund, which was actually a UK-operated small tech investment trust. Tech was still a dirty word in 2004 because of what happened in the .com. So, I think the average age of a mutual fund manager in the US is early 30s, early mid-30s.
Is it really?
Yeah, it's incredibly low, and that's bearing in mind they go to university or college for a lot longer than we do here. They haven't seen that cycle, so I think they're operating in a very different environment to where we started. But going back to the exciting capital, it was mining and oil and gas, and that just hasn't happened over the last few years because it's not viable.
Well, that's where the underinvestment in that sector bites. It's not the Shell and the BP who've got access to capital relatively easily. It's the more junior, to use your term phrase, exciting miners, right?
Yeah. And there's a human resource issue as well. I mean, there was a good podcast about it, one of the Bloomberg podcasts I listened to a while ago. And if you think of a Chevron or an Exxon, there is no one there, my generation, working in those companies because they've A, been laying people off for the last 10 years, and B, it's just not cool to go become an engineer in an oil company. Who wants to do that? Particularly if you're...
And if anyone knows cool, it's you, John.
Well, exactly. So, it's a middle name. So these companies have got huge problems in actually getting staff and getting kind of knowledge and know-how experienced
Undoubtedly.
positions to be able to
Yeah.
grow and to be able to find more oil. So, potentially the world is facing a bit of a crunch, I think.
The other part is, traditionally, oil and gas and mining was funded by syndicates. A number of banks would come together, syndicate of debt and loan in together. Because of ESG, shareholders of said financial institutions are actively encouraging those loans not to be made. So you've actually got a complete lack of investment as well going into it, or the ability to, you might used to have, say, a syndicate of eight banks. Nowadays you'd be lucky to have 3 or 4. So the terms just aren't as attractive, and there's not as much capital being lent to the industry. So it's all, the oil price. I think constructively, it's there's lots of reasons for there to be support around where it is, and on that basis, yes, as JR has said, oil's not $120 a barrel. It goes back to your question of, are they over-earning? Potentially, but I think the valuations probably reflect that.
Yeah. So we've had a bit of a mean reversion, a bit of a snapback anyway. So let's hypothetically say I'm a client speaking with you. I look at the performance of the Footsie over the last year. We all know the Footsie, the large cap index is pretty well diversified geographically, overwhelmingly global. What's the point in holding explicit overseas exposure? And John, you shared this chart with us before recording, which, all right, we're not saying for a moment that the UK is Greece, but in any given year, you've probably got, I looked at it the other day, you've got over 60 major developed stock indexes globally. The chances of the UK being the best performing one are pretty negligible. In that sense, it pays to have a wee bit of a spread, but the other one that springs to mind, not just Greece here as we can see on screen, but Japan.
Japan's been awful for 30 years. Yeah, if you look at history and you look at developed market equities, the cult of equity is such that equities always go up. However, there are instances in history, you have wars and revolutions and inflation have been the primary killers of equity market indices. So, Russia in 17, Germany in the 30s and again in 45. But this is Greece, and the chart shows the MSCI Greece index going from 40 to 150 in the good old days of the mid-noughties, and then from 150 down to, 5?
What is in the Greek index, by the way?
Probably.
Did you look?
Bit of shipping, I think.
Bit of shipping, a few banks.
Feta cheese.
But, nothing like that has really happened to Greece. They've been through Eurozone debt crisis, sure, total write-off of their debts, but they've not had a war, they've not had a mega inflation, and they've not had a revolution. And this is a developed market index. And if you were, a Greek investor, it's just fair to say you'd been much better served by being globally diversified than being in the local stock market. So, yeah, we do need to be slightly careful sometimes with that pronouncement that equities always go up, because that's not always the case.
I think we just have to be very mindful of the stocks within our home biased index. So
yeah, that's what it is. It's sectors rather than geography.
I think so, and it makes sense for our UK clients to have more of a home bias because they typically spend in sterling, earn in sterling, and portfolios in sterling. But if we stop the danger with the LSE is if we stop attracting the new businesses who are looking to IPO, if we're no longer an attractive place for those businesses to list, I suspect naturally our allocation to the UK will fall anyway. But we do have to be very mindful of the constituents within it, and whether we want exposure to those areas or not. I think it's disappointing we struggle to get sort of more exciting tech businesses into the UK, and part of that is I think UK investors aren't particularly good at valuing tech businesses. We tend to be more critical. There's been a few tech names recently that are quite exciting stories that have been a disaster because short sellers have got hold of them, or just UK investors aren't very good at valuing those businesses, whereas if they list on the NASDAQ, as an example, they tend to get much higher valuations. So if you're a company looking to raise capital and list somewhere, the natural place to go is probably the NASDAQ.
I have this really boring theory as to why this trend has reversed recently, probably from the 70s, 80s. I think the UK is just of declining relevance in terms of the global stage, in terms of the MSCI World Index. I mean, I don't know what it is in the 70s, 80s. I'd take a guess that it was over 15-20%. Now it's 3.
Yeah, well, it was the biggest stock market in the world around World War One, and it was overtaken by the US and never really looked back.
Yeah, I mean, now you're looking at the performance of, if you're looking at the performance of global stock markets, I mean, the States is 2/3, right? So that's clearly the key component. We've seen a bit of the main loser, if you like, with the UK being as one of the winners. One of the main losers recently has been the US, right? Because it started to underperform the rest of the world, as we can see here, for the first time in a very, very, very long time. I mean, look at that run of form versus the rest of the world. I think the reasons for that have been covered pretty well elsewhere. Big tech weighting. Do we think that trend is going to keep going? That the rest of the world outperforms the US?
I mean, interestingly, before the financial crisis, the 10 years before, actually, the European index was outperformed the S&P. And I think, again, it comes back to the constituents within the index, but higher rates, higher inflation benefited at the time the businesses within the European index. Lower inflation, lower rates really benefited these hugely innovative businesses that were growing on cheap capital. And again, the globalization really helped. The move in technology, people moving to the cloud, and I think access to customers on a global basis just went ballistic, and we all saw who benefited from that. But as debt has become more expensive, as there's less PE money being deployed potentially, that really quick growth, I think we're in a different environment. I don't think things probably happen quite as quickly. I'd be surprised if the next 10 years in terms of the US are the same as they have been over. I think valuations got, with the benefit of hindsight, got stupid in some areas.
It's difficult, isn't it? Because when you look at 21 times where it was in 2021 and think, well, clearly that was overvalued, but we're 18 months down the road. Trying to think back to how we were all feeling back then, I think we all got the sense that things were overheated, but we're not the sort of shop to play in the really, really speculative type stuff, so we were never in the really, really grossly overvalued stuff. But I think there's a general sense you can feel that things are overvalued, but things can stay overvalued for a very, very long period of time.
Valuation's not your guide to what's going to happen in the short term whatsoever. Just look at the 90s. I mean, the US equity market got expensive in 97, and then doubled if not tripled from there. Japan in the late 80s. So, it can feel like things are overheating, but what are you going to do? Sell the minute the PE goes over 16? Well, you're probably going to miss out a lot, aren't you? So you just need to be pragmatic about it. I think I agree with James. I'd be very surprised if the US has another 10 years like the last 10 years on a relative basis.
You mentioned, James, about rates, and Johnny, you shared this chart before we came in. Do you want to talk us through what's going on here? So
if we go back to those halcyon days of 2020, 2021, the S&P was on 22 times earnings, but what was the alternative? And it was the TINA acronym, wasn't it? There is no alternative because US Treasuries at the time were yielding 1%, 1.5%. Cash was getting you naught. We all know about that. Financial repression. You were being pushed to buy assets. Today, you can buy a US 10-year Treasury at 4%, or 1-year Treasury is basically 5%. 5% for no risk whatsoever. Now US equities today are on 18 times, which means that that valuation gap, if you like, between equities and bonds in the US, and the same is true in the UK, has shrunk. Therefore, the relative attractiveness of equities, it's no longer there is no alternative, it is there is now an alternative, and that's the alternative team.
And what you can see here is basically the relative attractiveness, right, of buying a company versus buying the risk-free rate.
Absolutely.
Because this is the earnings that a company is spitting out.
Now, you could sort of argue that 5% interest rate that you can get on a 1 year today is a sort of, that's not the new normal over 30 years, and that's not going to last very long because rates should come back down again as inflation moderates, and maybe there's a recession, so maybe the US equity market at 18 times still looks okay. But and we see it with our clients walk in the door. if you were a traditional cautious conservative investor with a lowercase c, and you wanted a steady 4-5% return with as minimal risk as possible, we couldn't do that for them a year ago, 1 year ago, because bonds, high quality bonds, were yielding 1 or 2%. We couldn't get to 5% by going down that route, so we had to buy equities. Today, step this way, sir. We can buy you some gilts. We can buy you some high quality corporate bonds yielding 5.5%. You can have a little bit of equity as well if if you're happy to. But the game has changed, and therefore we don't need to be putting quite so many clients into more medium and higher risk portfolios with more in equities, because the returns that those clients want are available on bonds. Now, yes, okay, inflation is currently 10%, but that should moderate. Should moderate quite significantly as the year goes by. So, one can make an argument that the S&P today is more overvalued at 18 times than it was a year and a half ago at 21 times.
I mean, interestingly, I've actually had the other side of the conversation as well, which is clients that are looking for growth and historically have had the large proportion of the portfolio in equities. Actually, when decent, investment grade corporate bonds are giving you 6-ish, maybe a bit more in institutional lines. Now, actually, I wouldn't mind 10-15% of the portfolio in direct names. And I've got, particularly with the year we've had, I've got a lot of sympathy for that, and being able to lock in very nice returns from arguably corporates with better ratings than sovereigns in some cases. It makes a lot of sense. In truth, I'm quite excited about the environment we find ourselves in. I think, it's going back to proper portfolio management in terms of there is an alternative. We can look across lots of asset classes now, and we, as JR said, we were forced to take on, more equity risk and or use alternatives which had
may or may not work.
May or may not work, had more of a linkage to equities. And we thought we were being very clever in lots of cases, having underweight fixed interest positions because we were concerned about where rates were. But actually, on the other side, the alternatives we thought would probably protect us a bit more, probably haven't protected us as much as we thought they would.
It's been a mixed bag.
It has been.
It's almost some like have been alternatives as a label for a very diverse asset class. Isn't particularly
ultimately,
apt.
I think we should leave alternatives to another episode.
Very good point.
Views.
Let's. I want to get to the economic stuff, so let's zip through US equities. I mean, the technicals look really good, right? Do you want to take us through these? I mean, because you sent these across.
Well, we need the CFA to do the technicals.
I haven't got a hope.
So statistics, innit? So there's a few sort of triggers in terms of what the market does after it sees a 20% decline, and a few of those triggers have been hit, and not just on this one we've got here on the screen now, but historically, when the S&P has done what it's done now, i.e. risen above its 200-day moving average, which essentially is its 1-year average price, if it's done that for more than 18 days, it's never gone on to fall back below the previous lows, which suggests that, historically, or from an historical perspective, the lows for this bear market have been seen on the S&P. Caveat that, sample size is 11 or 12 times, so that's not particularly
as in it's happened 11 or 12 times
it
before
has since 1958. So the technicals look pretty good. The market's had a strong bounce.
How do you think about technicals? Because I've spent more time looking at technicals over the last 12 months when I've been in an absolute bear market than I have done in my entire career.
I'd never base an investment decision on a technical, but I think they are useful to look at. I think for me, relative strength is quite important around stocks, and also benchmarks, indices. But some people use technicals a lot more than I do within our business. I think some will never use them, but I think alongside fundamentals, they're useful to look at, and particularly something like this is important to look at. I think it's a really interesting point, because I think a lot of the market and a lot of investors are slightly cautious of the run we've had this year. Or
Sentiment's not great, is it?
No, since September last year, probably. And I think it's just been because the bounce has been so big. We're still waiting for the consumer to potentially fall off a cliff, but when you look at something like this, and it's interesting, and we often say, if everyone's thinking one way, usually the opposite happens. It's Buffett. We all quote him, but be greedy when others are fearful. And
undoubtedly, I think it's amazing that we all recognise that in the short term, market movements are totally unpredictable and almost even chaotic.
Yeah.
But we're all human nature is to look for these patterns, right?
Definitely.
And on the basis that I've been reading his latest missive before we came up, and about to pick out some bits and bobs from it. This really caught my eye. So this is from Jeremy Grantham's recent piece, which is nice and cheery. It's called "After a Timeout, Back to the Meat Grinder." So you can tell it's going to be positive stuff. But one of the elements that he picks out of it, which is pretty remarkable, going back to 1932 for 7 months of the presidential cycle. So basically, from the 1st of October of the second year, which was the 1st of October 2022 for this cycle, through to the 30th of April of the third year of the presidential cycle, so 30th of April coming, the returns since 1932 equal those of the remaining 41 months of the cycle.
That's amazing.
So basically all of the returns of the presidential cycle tend to come in a 7th month window, which is closing on the 30th of April. Yeah. He says this has a less than 1 in a million probability of occurring by chance. This stuff happens everywhere. There's little patterns everywhere, and there's reasons that you can put in your mind, narrative that you can use to explain that. Probably that the president, whoever's in the White House wants to spend a few quid, maybe. But that's pretty remarkable. That's been the case since 1932. So, what's he saying there? Go mega long until the 30th of April, and then flog everything. Who knows? Not investment advice, of course.
No, but it was quite a cheerful piece, wasn't it?
I mean, let's deal with it now. I've been waiting for a while to deal with it. Let's just get stuck into it. Okay. So here's a few quotes I picked out. I believe that a continued market decline of at least substantial proportions, while not the near certainty it was a year ago, is much more likely than not. My calculations of trendline value of the S&P 500 adjusted upwards for trendline growth and for expected inflation is about 3,200 by the end of 2023. I believe it is likely 3 to 1 to reach that trend and spend some time at least below it this year or next. For example, to put this into perspective, it would still be a far smaller percent deviation from trendline value than the overpricing we had at the end of 2021, over 70%, so you shouldn't be tempted to think that it absolutely cannot happen. For an example of a real nightmare, in 1974 the S&P troughed at below 7 times earnings. I'm going to tell you now why the S&P is not going back to 7 times earnings, and it's because of this chart on screen. The companies in the S&P are just much, much, much better companies than they were in the 80s.
But so they used to make widgets and railroads and steel companies and oil companies, and they're now Apple and Amazon and Microsoft. I mean, there's people who compare valuation over time and not living in this planet. Margins are so much higher. There's so much better run. The business models are so different. There's no comparison for me.
Yeah, 100%.
So this is showing you the amount of employees it took back in the 80s to generate $1 million of revenue compared to today, and obviously it's creators. I mean, this just shows you human progress, right? Companies become more efficient, more profitable, and shareholders benefit from that over time.
I think, yeah. I mean, also you've got to look at what the earnings growth is. It can't just be on a historic basis on what the PE is. What where we sit today. I know we've just gone through. We're almost through another earnings season, but it has been lower than the growth rate has been lower than historical averages. But if you look at, there's lots of brilliant businesses within the S&P that are still growing at very exciting rates, and that's why I completely agree. The S&P is not going. It's not going to 7 times earnings. I mean, if it does, if it does, the farm's being sold and we're leveraging up.
I mean, this is the thing, right? Because, you know, we sit here and obviously, you know, this is what we talk about, right? We talk about valuation, talk about what's going to happen in the short term, but ultimately the tide is only ever going in one direction.
A hugely important point, and completely missed by so many investors. We all have a certain amount of our pension, a certain amount of our salary has to go into a pension. Access to investing is so much simpler than it's ever been. Now, in the old days, to invest, to buy a stock or a share or a bond, you would have to physically go into an office and set it up, and it's just.
What was your commission back then? About 5%, was it?
7. But you know, it just wasn't easy to do. These days, you can set up a platform. You can set yourself up on a platform in probably 10 minutes. KYC, money laundering's done immediately. You can deposit your cash immediately. You can buy whatever you want pretty much immediately. It's just that, you know, these huge pension schemes, particularly in the US, they are massive net buyers every single month of equities.
Yeah.
And
as are we through our pension contributions.
Exactly.
Every month.
Exactly. And you know, those contributions will get bigger and bigger. They just have to be, because ultimately we are going to be less dependent on the state when we get to retirement age, and our children will be even less dependent because the state can't afford to provide pensions in the way that it used to.
No.
The state pension just will not be adequate to retire on properly as you know, as our generations get older. You know, in Australia, they have superannuation funds, and the percentage of salary that has to go in is substantially larger than it is here. I think it's 10%. Don't quote me on that, but I think it's 10%. Whereas here it's obviously
3, isn't it?
Yeah, exactly.
Yeah.
But the plan by the Treasury will be that 3% grows, so that we all have much larger private pensions.
I love the point that you make about access to investment, because there's a lot of doom and gloom, and you know, I've spoken in the past about how pessimism naturally makes you sound smarter than optimism, but one of the great strides that we've seen over the past couple of decades is just how accessible investment is to everyone. Causes problems occasionally when you have market environments like a couple of years ago, but in terms of ease of access, it's night and day from where it was.
I think it's amazing for everyone that, you know, it's not just a certain class of person that can invest in companies, and you know, the idea that, you know, young people, brands they like in particular, you know, whether it's Nike or
Disney,
or Adidas or whatever else, they can actually buy shares in those companies.
Yeah.
I think it's really exciting, and you know, they can get investor reports or be invited to special, you know, to certain events sometimes. I think it's really good, and there should be a lot more education around it at school as well. I know there's been some talk from Rishi about making changes on that, but we can probably have another video discussion on that anyway.
Yeah, one for next time, guys. One for next time. Let's stick to simple things at the minute, like the economy. Does anyone have any clue where that's going? I know economic predictions are not our bag anyway, but we're on a podcast, so let's have a go, lads. This is all. It's a very, very confusing environment, or it feels confusing to me.
Yeah, but I mean, PMIs, service data. There's no clear picture on where we are. I think, you know, you still got. I mean, fundamentally, I think you go back to what monetary policy has done, and you've had a huge expansion of monetary policy through COVID, you know, for lots of good reasons. But I think, you know, money supply increased by 40% in the US. You've had a huge reduction in that recently, and you know, these are really powerful policies, and we just haven't seen this sort of change in money supply before. It's or not recently, and it's very difficult to understand or to try and predict.
We're still coming through that, aren't we? So
we are.
You know, the pandemic, we were all sat at home, and then we realised Amazon was still working, so we bought loads of stuff because we couldn't get our hair cut, we couldn't go to restaurants, so we bought hair trimmers. Some of us did. Dave didn't.
Unfortunately, unfortunately, I bought a few too many hair trimmers. I went a bit rogue on top.
And we bought loads of goods, and that helped the PMIs because the makers of stuff and the makers of goods had a wonderful time in 2020, 2021, and then as soon as we were allowed back out, we didn't need to buy any more stuff.
Yeah.
I bought a barbecue, bought some garden furniture, bought some gym kit, and I want to go out with my mates now. So goods demand fell off a cliff. PMIs went weak. Allied to that, we had war in Ukraine, gas prices going up, which was pretty terrifying.
Yeah.
We had the historical anomaly, I think, of the mini budget in the UK, which set the cat amongst the pigeons. Interest rate expectations went through the roof, bond yields went through the roof, and that's now all unwinding because gas prices have encouragingly pretty much collapsed. So you've got lots of kind of messy stuff in the data, and it's almost too difficult. Most people 2 months ago were saying that the US and the UK and Europe were nailed on for a recession in 2023, and it would be impossible for them to avoid that.
Yep.
Now, not saying that we will avoid a recession this year by any stretch, but
I think we're in one.
the things that have happened that needs to happen to avoid a recession has happened. I.e., interest rate expectations have come down a little bit, apart from this week maybe, and energy prices have come down, and all of a sudden the consumers had a bit of a release valve, and maybe most households haven't felt the impact of higher mortgage rates yet, particularly in the UK.
I mean, that's the big one, isn't it? Because there will be lots of people still fixed on 1.25, 1.5.
Speak for yourself, James.
It's a bit of a sore topic over here. He's locked in for the next century, basically.
That's definitely not true.
But as we roll, the next 6 months, there's going to be more maturing mortgages. The next 6 months after that, and these are really meaningful interest rate increases. They are taking significant consumer spend away from different areas, and I think people with mortgages coming up for maturity are very aware of what's going to happen, but it's almost, there's no point in worrying about it until it's done. I think the consumer, what the consumer does is always a lagging effect. It's never an indication of what the future will hold. The consumer usually spends all of the consumer's money until they can't spend any more. So we don't really know where we are until we get to that place.
It's never a good idea to bet against the consumer in the US in particular.
No, and they've still got savings built up from the pandemic. If you take trend savings and cash deposit levels and you extrapolate it from pre-pandemic, obviously you had a big spike in the pandemic of built up savings, and that's all now being chipped away at, but there's still quite a lot of excess savings potentially still there, which is weathering the US consumer through. And we had some numbers from Home Depot yesterday, didn't we, which were not, they weren't the most cheerful, but they were okay. They weren't disastrous. But generally US retail sales in January, the official data was really strong, surprisingly strong.
But as you were saying before we started recording this, there was a really interesting article in the FT on the impact of the weather.
Yeah, the weather has had a massive impact. They had no snow in New York in January at all, which, if you think about what happens in the UK when it snows, the whole country grinds to a halt. If you expect snow and you don't get it, and you work outside and you're in construction or you're whatever. So, the seasonal adjustments are probably not quite there, and it was the same with the payrolls numbers. Maybe the seasonal adjustments will wash through in the next few months. So I think at the moment, taking 1 month's data and extrapolating out and judging the health of the economy that way, particularly since you've still got the pandemic impact on certain sectors and the energy shock, then I think it's too much to kind of take a snapshot view of what's happening right now. I think it's just too difficult.
I mean, we really did get lucky on gas prices and how warm the weather was.
Yeah.
I mean, it was looking absolutely dire in October time until we realised Dave was still in shorts and t-shirt coming into the office in December, weren't you? So
Hardy. No heating on in our house. Absolutely not. I mean, one of the really, maybe surprising in one sense, the job market's been brilliant. The job market has held up really, really nicely. We've discussed this before. Jobs are probably one of the last thing to go. You sent me this before, which I thought was quite funny. But are the robots coming to take our jobs? Because 5 years ago, that was a genuine concern that a large swathe of the population would have their job napped off them by a robot. Now, when the cost of labour is significantly higher than it has been in recent memory, actually, maybe automation's quite attractive to companies. giving AI as the topic du jour. You've got choice of one, Google or Microsoft. Which one are you backing?
The valuations come into it.
No.
No. Okay.
I mean, it's fair to say Microsoft have got the head start with the investment in OpenAI and ChatGPT.
Yeah.
Does first mover advantage make a difference? Maybe. I find it quite difficult to bet against Google, given the outstanding innovation that they've developed over the last 20, 30 years, and the quantum of people they've got there, of good people they've got there.
There's a lot of projects going on in the background as well, which there's a lot of cash that gets burnt up because it's trying to show that it's not, the monopoly it has, or virtual monopoly it has, isn't quite as cash generative as perhaps it is. So I think they are doing a lot in the background that we won't really hear about.
No.
And
maybe they were caught off guard by the announcement and the release of ChatGPT, which quickest new innovation to hit 100 million users.
Was it?
Yeah.
Quicker than WhatsApp, quicker than
because it's
Facebook.
been writing my blog post for the last 6 months.
It's predicted a stock market crash on the 15th of March, isn't it?
Yeah, almost certainly. Has it?
Apparently, that's what JR was saying.
No, I don't want to bet against Google, put it that way.
I'd take Google
I'm
as
going
well.
I'm going to go with Microsoft.
Oh well, listen. We need a bit of conflict.
That's what makes a market.
100%, 100%. Just the point about the job market. I thought this was really interesting, John. That stocks do well when unemployment rises.
This is totally counterintuitive, isn't
It's
it?
totally counterintuitive. But I feel like this is time for the weekly announcement. The counterintuitive things happen all the time.
Yeah. I mean, actually, once you think about it, it does make a lot of sense. When the unemployment rate is high, it means you're normally in a recession already, because unemployment is the last thing to go in a recession. So when you buy, the stock market's a forward-looking indicator. Hence, if you're buying it in a recession, it's probably already down, because it probably already fell 6 months ago, a year ago. Thus, your returns from that point forward are probably very good, because you're hitting the recovery.
How about thinking about it that unemployment's high, the workers that are left are working extremely hard to keep their jobs. As the acceleration...
that's a dystopian way of thinking about it.
The acceleration in revenues comes on a much lower cost base.
Maybe.
And then,
I remember...
And then you get your stock returns.
I think you're coloured a wee bit by like your formative years, I think, in the stock market. And I've only been doing this about 12 years, but I can remember meetings that I was sat in the early years, and every single company or fund manager that invested was talking about companies cutting costs and laying off staff, and zero-based accounting was the topic du jour. And it felt like that went away for a while, and now we're seeing stocks start to pop when they're announcing layoffs. So maybe actually there's a bit of that probably in what we're seeing here on screen. I think that probably continues for the near term. I think Meta's earnings call was pretty instructive on that point. We've gone from torching cash into the metaverse project. Whether it works or not is kind of moot. But now the talk was about restraint and efficiencies, and I think you're seeing that from companies now, and it probably goes, this is the business cycle, right?
Yeah, and I think there's been another thing, COVID... I think COVID almost gave a lot of power to employees in terms of how they wanted to work, and lots of businesses have struggled to get workers back to the office. I think that tide has probably turned with recession in the headlights, people worrying about future costs and thinking, actually, I probably need to be seen a bit more by my manager, or actually I need a pay rise because the costs at home have gone up 20%. I better work a bit harder and come into the office. I know that's being quite a that's maybe being slightly harsh, but I do think there's an element of that.
I totally agree.
Across certainly UK, US. You've had some tech companies now that are actually saying workers have to come in 3 days a week. A year.
Elon Musk has been big on that, hasn't he?
Yeah. I mean, a year ago, that just wouldn't have worked.
Yeah, but then, like, a lot of these, particularly tech employees, get paid a large proportion of remuneration in stock, and their stock price is created. So they themselves are incentivized to get the stock price higher, share price higher, which is why Meta, Facebook, no longer talk about the metaverse. They talk about efficiencies. I think efficiency was the most used word in Zuckerberg's transcript.
Yeah.
Cost cutting, margin, all makes a lot of sense
All
because
the
they
good
need
stuff.
they need to get the share price back up again.
Yeah.
Do you think we're in a recession or going into one?
I don't think we're in a recession now. I think I'm going to really sit on the fence and say a soft recession. It's just really hard to see from the data. I think if we were asked the question 6 months ago, the answer would have been very different, which was we're definitely going to recession. I think we have all been very surprised at how resilient the consumer has been, and the earnings that have come out again are. We are really lucky that we can invest in some seriously high quality businesses with excellent management teams, and we can sit alongside those management teams and share in future profits. I think actually businesses are run, not all businesses are run very well, but certainly I think the ones we look at closely are doing a really good job. But I've been surprised at how resilient earnings have been.
I think we all are. I mean, it doesn't feel like a natural environment if you're concerned about an economic slowdown to be talking about banks, and the banks have done amazingly well. Talk me through the banks. Why are people buying the banks? Why do you like them?
Well, it's a pretty straightforward. I mean, they can park their cash with the Bank of England for 4%. The UK banks can. So James's current account, his savings account, has been used by NatWest or Barclays to earn them 4%, and they're paying him 0%.
Yep.
So that gap is called net interest margin, and that's 350 basis points, 3.5% they're earning on.
And
cash.
2 years ago it was
2 years ago it was zero because they were paying James nothing, and the Bank of England was paying them nothing. So
I mean, historically, that net interest margin has been 200 basis points,
probably, yeah.
and we're talking about 320, 350. And these banks are not expensive. If you look at what they're paying in dividends, their free cash flow yield, multiple of earnings,
capital ratios are high.
Capital ratios are exceptionally high. If you think actually they've done a pretty extraordinary job in an environment where they've had virtually no net interest margin, they've managed to batten down the hatches. They've managed to rebuild those balance sheets, cut their costs, and in reality show some growth. And now the interest rate has started going up. They're sitting pretty. I mean, it was a bit of a surprise. The UK banks reported last week, and there was a bit of disappointment around a few of them because the net interest margin wasn't quite as high as probably the market wanted. I think my instinct is there was probably some pressure put on them to give deposit holders a bit more than they probably needed to.
I also think there's some disintermediation. So come back to your point about opening a brokerage account on wherever in 5 minutes flat.
Yep.
If NatWest are paying you 0.5%, but you can get 3% with Marcus or Chase or whoever it might be, go and have a look at Martin Lewis's website and he'll tell you where to go. And you could open an account on 5 minutes flat on your phone. You're going to do that for the extra 3%. You wouldn't have done it a year or two ago if the marginal benefit was only 1% a year. So I think disintermediation in the banking sector, access to online accounts. You can buy a money market fund, which is not cash, by the way, it's a security, and that basically gives you Bank of England base rate. It's 4%. You can buy a 2-year gilt for 4%, which is backed by the government. So a lot of cash has found its way out of the banking system, or the legacy banks that haven't been paying savings rates, into these other areas, and I think that came through a little bit in the numbers, particularly NatWest, Barclays to a degree, wasn't it? So banks can't milk that net interest margin maybe in the same way they could historically when we had to go to a branch and write an application form.
I think there was an element as well is political. The outlook statements were cautious. I think if it had been another industry where you haven't got such public pressure and dislike for a certain, for the banks, I think they could have potentially been.
I think the energy sector takes the biscuit at the minute. No.
Very true. Well, both. But I think.
Well, the government still owns half. Half now.
Yeah. It's not a good look to be a cash machine as
exactly
as BP called themselves when you're owned at least partially by the government.
Exactly. I think, you know, there is an element of trying to placate's probably the wrong word, but not scream from the rooftops in terms of how much money you're making. And I think on the other side, it's never been right to own banks heading into a recession. So
I said that. I posed that very question to our banks analyst Will yesterday.
I bet he liked that.
But this is the most telegraphed recession ever. So.
Very true.
Yeah.
We didn't ask you are we going into a recession? We didn't ask you the question.
I think we're in one, but
okay.
I'm from Northern Ireland, so my default settings are miserable.
John?
I think.
I would be shocked if we don't have one this year. So I do think we will have one, yes.
Yeah.
Perfect. That was fun, fellas. Maybe
That
not
was
the end, the
brilliant.
conclusion. I've got Alex waving at me, telling me that we've reached time. We're trying to make this a regular thing, folks. So we're going to be doing it every couple of weeks, hopefully. If there's any topics you have, any burning desire for us to talk about, then drop me a note at david.henry@quiltercheviot.com. But thanks to you two fellas. Did you enjoy yourselves?
Really enjoyed it.
It's been good fun.
What are you doing at the weekend?
I will hopefully get outside for a bit of a bike ride, I think.
Been putting the miles in on Strava recently.
I love it.
I will
Absolutely
probably
love it.
not be watching Wales against England because Wales are probably on strike.
Is that going to happen?
It looks increasingly so. Okay.
Really? Yeah, well, there we are.
The Dons have got
and
Gillingham away, so I'm on that. I'm
Yeah.
on that detail. But
Okay.
thanks very much, guys. That was a
really
blast.
enjoyed that.
Cheers.
Thank you very much.